This is a problem dealing with how you work from the bottom of the income statement up to the top. And what you're going to learn with this problem is something that you'll use in the very last chapter of this course, which deals with break-even analysis. But at any rate, we're going to learn how to work from the bottom of the income statement up to the top. Now this problem reads like this. It says Herman Industries is forecasting the following income statement. And they give us the income statement there, and they're forecasting $1,320,000 in net income. The CEO would like to see higher sales and forecasted net income of $2,500,000. Assume that operating costs excluding depreciation and amortization are 55% of sales, and that depreciation, amortization, and interest expense will increase by 10%. The tax rate, which is 40%, will remain the same. Note that while the tax rate remains constant, the taxes paid will change. What level of sales would generate $2,500,000 in net income? Now, that's the problem that we're going to solve here, that we're going to look into. Now again, the CEO doesn't want $1,320,000 in net income. The CEO wants $2,500,000 of net income. And we're going to work from the bottom up. You'll see in the problem in the book here. Now you can see that the taxes are 40%. So how do we go from net income to earnings before taxes? Well, you have to remember now that what we're looking at here says that earnings before taxes is multiplied by 1 minus the tax rate gives us net income. So if we want earnings before taxes, we take net income, divide that by 1 minus the tax rate, 1 minus 0.40, which is 0.6, and that gives us $4,166,667. They told us that under the old forecast, interest expense was $600,000, and that if we're going to want additional net income, we think interest expense will increase by 10%. So if you take $600,000 and multiply it by 1 plus the growth rate, 1.10, you get $660,000. Earnings before taxes plus your interest will give you your EBIT, this number right here. EBIT, operating profit are the same thing. EBIT stands for earnings before interest and taxes. So if you take EBT plus interest, you get $4,826,667. They also expect depreciation and amortization to increase by 10% if we go to this higher level of activities. The old level of depreciation and amortization was $800,000. Multiply that by 1.10, 1 plus the growth rate, you get $880,000. If we take earnings before taxes, add to it depreciation and amortization, we get what's called EBIT-DUH, which stands for earnings before interest, taxes, depreciation, and amortization. And that gets us $5,706,667. They tell us in the problem they anticipate operating costs being 55% of sales. Well, that means if you take EBIT-DUH and divide it by 1 minus operating costs as a percentage of sales, we would get sales. So if you take $5,706,667, divide that by 1 minus 0.55, which is 0.45, you get $12,681,482. And that's the level of sales that we would need to generate $2,500,000 in net income.